What happened to the face ripper rally? The market wasn't up today. Not only was it not up today, but a lot of the more growthy stocks were down. All the indexes were slightly down, but for many of our portfolios, it felt like there was a little bit more of a hit than we were expecting or saw in the market. And I advise you not to fear unless your portfolio is poorly positioned. You shouldn't fear if what you have are well-priced energy stocks, anything highly correlated with inflation. Don't fear if you have those stocks. Those stocks are going to run. They are going to have their time. We are certainly seeing inflation. I just found out my Caniac combo at Canes is now $12.49 versus 11 something. And that's probably going to keep going up. So there is reason to believe that commodities, things like energy, other cyclical companies, will continue to see inflation, and the stocks are only just beginning to reflect that. I don't think a lot of possible gain has been realized there. If you have those stocks, don't have a short-term mindset. Don't look at today and be worried. Continue to hold. This is a longer process. As we have said, and as the saying goes, stocks take the elevator on the way down and the stairs on the way up. We're not down big today. There wasn't anything of concern that happened. It's just simply a cool off. We're on the step of the stair. If you have well-priced tech or tech that you view as undervalued to a 5-year, 10-year story, you shouldn't be concerned. I assume you have that stock realizing that there will be some volatility in it. And, I expect bond yields to rise. I don't think that should have an impact on stocks because I think real bond yields won't rise, only nominal bond yields, because there's broader inflation that will affect all areas of the economy. Even stocks that have long-term future cash flows. And people say tech stocks should sell off when bond yields rise because bond yields are now offering more attractive future cash flows versus tech stocks, which offer future cash flows. But I challenge that notion with the notion of inflation increasing long-term nominal future cash flows. So I think that point about rising bond yields is moot, but it may provide some volatility to those tech stocks you love. Regardless, you love them. Keep holding them in your portfolio and acknowledge the risk. Consider offsetting some of that risk with stronghold cyclical companies that are well priced and possibly pay a dividend. If you have those two areas of the market, which I do, your portfolio will be well balanced. You will feel confident, in control, and be able to ride out strange feeling days like today kind of was. The one basket you don't want to get yourself caught up in is the SPAC craze of the past. We have seen how that has ended. Those stocks have not recovered for good reason. And other more broadly expensive tech. We certainly have excessive liquidity in the market. It's a highly speculative environment, but it's not too speculative because there has been a lot of stimulus. It's not like we're in a crazy bubble. That is, in my opinion, a possibility that has been taken off the table for the previous two buckets, but not for the third. If you own something like DocuSign or Zoom, those stocks are very expensive. Anything that resembles that, remotely resembles that, or has a story that involves a lot of competition, any of these kinds of things, but is priced at the entire valuation of the future market, assuming they get 100% market share, these kinds of things are stuff you don't want to own in this environment, especially because there is the possibility stocks sell off on rising bond yields, which is a story I think is only just beginning. Although there's a possibility that it doesn't because the Fed is staying super dovish, but I don't think that's necessarily the case in the long term. And if you're going to have a tech stock, chances are you're going to need a long-term time horizon because tech was the story of 2020, as it should have been. It was worthy of that. It has kept us all alive, tech. Now we are going to experience a reopening economy, and reopening stocks are suddenly going to become in focus. Everyone's going to be wanting to go to Six Flags, flying on planes, which are getting more expensive. Remember Hertz this time last year going bankrupt? People playing around with that stock. Look at the price of rental cars all of a sudden. They are crazy. I'm going to Miami this weekend. I'm not getting a rental car. It's cheaper for me to get like a dozen Ubers. Literally, a dozen Ubers. That's how expensive a rental car is. So, reopening stocks, cyclical stocks, and commodity stocks are the new tech 2020 stocks. These are the 2021 story stocks, and these stories are only just beginning. They have plenty of haters still, plenty of doubters, and they're well priced. They were well priced before Corona. A lot of the market's above Corona levels. These stocks are below Corona levels. And if you're buying something like energy, which has been hated on for an extended period of time, pays a good dividend, and is investing for the future, countering the thesis that has put so much pressure on these stocks, you are getting yourself one effing hell of a deal by buying that stuff, especially Exxon, in my opinion. So venture into those areas. The first two buckets, stay away from the third, and you'll be doing all right in this market. I believe in you. And until next time, peace out.